there's a tendency to want to be like other people who are in that position. So for instance, if your head of research is a certain way and their skills are XYZ, you believe that you have to have those same skills to be in that position. And someone told me a long time ago, before I became the CIO, they said, the role is whatever you make of it. And so just widening your aperture to say, what type of director of research do I want to be? What type of analyst do I want to be? What are my strengths and what can I bring to the table for the company?
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunn, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunn.
Thanks for the introduction, Niels. Today I'm delighted to be joined by Shannon Saccocia. Shannon is Chief Investment Officer of SVP Private, the private banking arm of Silicon Valley Bank in Boston. SVP is a $17 billion RIA, and Shannon has been involved in financial markets for going on a couple of decades now in a variety of roles. She's a frequent speaker and commentator on markets. Shannon, it's great to have you here today. How is all on your side?
Doing well, thanks. Thank you so much for having me, and good morning here in a very sunny Boston this morning here in November.
Good stuff. Well, it's great to have you on, and it's typical for us just to get started to hear a little bit about the background of the person we're speaking to. So could you just give us an outline of your experience, how you got involved in financial markets, and what took you to your current role as CIO?
Absolutely. It was a little bit of a path for me, kind of going into college. I really expected to be in the medical field, actually. I was pre-med, looking to be an epidemiologist, which prior to the pandemic over the last couple of years, really no one knew what an epidemiologist did at the time, unless they had seen the movie Outbreak, which, if you recall, followed some CDC epidemiologists. But coming into my sophomore year of college, I fell in love with economics and decided that I wanted to do something as it related to economics in my career. Really anticipated actually being in academia, but got a job right out of school at State Street, which was a large custodial bank here in Boston. Spent about 6 years or so really on an institutional consulting path there, and decided that I wanted to switch over and be in the private wealth world. So joined a very small, what was at the time, I was the 10th employee of about a $900 million RIA, and really got to wear almost every hat from an investment perspective in the 16 years since I joined that small RIA. So really have done everything from fixed income and equity trading, equity analysis, equity portfolio management. But I spent the bulk of my career in asset allocation, portfolio construction, and manager selection, allocating capital, building portfolios, attempting to find new opportunities that would be complementary and diversifying for our clients. And coming into this role, I've been the chief investment officer now for about 4.5 years.
Okay, great. And in terms of the types of portfolios that you're running, obviously it's a private wealth RIA business. Could you give us a sense on the types of portfolios, investment objectives? What's the kind of typical profile of the clients that you deal with?
Well, it's so interesting because as we've come together between my legacy firm, Boston Private, and SVB to form SVB Private last year, one of the things that we've noticed is that we have a much broader set of clients and solution sets that we really need to apply in order to meet their goals. We were sort of historically in the, what I would say, already wealthy camp. Many entrepreneurs, business owners, real estate developers, that were our sort of traditional client. Now we have the new clients that we have in coming from the innovation economy, where they're still very much in growth mode, looking to potentially, continue to invest in different companies. We also have a lot of VC and PE principles as part of our clients. And so the solutions that we really provide are trying to think about it in terms of what I would say are three buckets that generally tend to lend to outcomes, we start with liquidity. As we all know, particularly those of us who suffered through the financial crisis, liquidity can be at a premium, when it's least easy to unleash it. And so one of the things that we really talk about with our clients is making sure that we understand the liquidity they need, and also to be able to utilize that liquidity across a number of parameters to make it work best for them. And then on the other side of the equation, kind of all the way on the other end of the spectrum, is what we call aspirational assets. And, for many of our clients, that may be assets that they already hold, or they may be assets that they have through their professional experience. And so in that bucket, what we're really looking for is asymmetric sources of return and risk. If you think about, the parameters around that could include lower or no liquidity. It could include a potential for perhaps more concentration than we would accept in a more traditional marketable portfolio. And then in the middle is sort of the growth part. And I would say that's where you get, whether it's alpha or beta, but really from a marketable securities portfolio. So sizing those three across a client's situation and for a client's situation is really how we think about asset allocation. So although, we do utilize what I would say is a traditional asset allocation framework for our client reporting and the way that we lay out the portfolios for clients, those three, what I would call buckets, are really the way that we determine the right outcome for clients, or the right potential outcome for clients. And so we spend a lot of time thinking about, if there are specific investments that we're looking to vet or potentially include on the platform, where do they fit in one of those three? And are our expectations for those investments, solutions, strategies consistent with what we're trying to derive from those classifications?
Okay, interesting. And you mentioned how you've kind of had that evolution in the client mix over time. So presumably their weightings in those three buckets are a bit different. Is that fair to say?
It is fair to say, although one of the, I would say, misconceptions about younger clients, and I don't know that I fully embraced this misconception previously, but many people do, is that younger clients are have a higher risk appetite. And actually what we're finding is that, having gone through the financial crisis when they were probably, maybe have just been entering the workforce, and then having the pandemic occur, there's a lot of younger clients that I think are perhaps more risk averse than we would sort of model them through a traditional financial planning software, if you will. And so really trying to understand what are the drivers, what is the reason that they are investing, what are the drivers for their wealth in terms of long-term goals. And it seems that we're entering a phase, at least just from my anecdotal experiences, that this idea of accepting a reasonable return for perhaps a little less risk seems like it's more palatable to younger folks, and perhaps that goes back, and this is just conjecture. Perhaps it does have to do with the fact that they do have a long runway for earning, and so they're not worried about retirement per se, and for many of them, they're not even really worried about things like education or housing. They're still in that sort of prime spot of just consumption. And so I think, not really sort of knowing that they're going to continue to work for a long period of time and that the expectations are that they're going to make enough from an income perspective to really supplement allows them to perhaps be a little bit less risk on than clients who are closer to retirement and looking to really maximize their portfolio.
Interesting, kind of the opposite to what you might expect.
Absolutely.
Really, yeah, yeah. And I mean, we can get into markets in a minute, which I'm sure we'll get into in depth. But one of the things I've been thinking about is we've had this very sharp change in the landscape. Interest rates in the US have gone basically from zero, and the message is they're going to 5%, which is I guess, a huge shift because, for the last number of years, a lot of investment behaviors were motivated towards, how could you generate 2, 3, 4%, and now you can pick up 5% just by well, not yet, but if you believe Jay Powell, you'll get it from T-bills pretty soon. So, do you think that's going to have a big shift in terms of investor behavior, or are you sensing that already, or how are you thinking about that?
I do think it's going to be a big shift, and I know that this has been an incredibly painful year, and I think it's important to acknowledge that. I mean, I think that investment professionals tend to operate in the historical precedents and those and the acknowledgement that we know that, things like if you look at equity markets over a period of time, they go up over time. And if you look at significant drawdowns, you can go back sort of in history and see that those drawdowns were regained and that there were additional gains on top of that, post a severe drawdown. But in the moment, that's obviously very difficult. And so I think it's important to acknowledge that this has been a really challenging year. However, I would say that, this entry into a more normalized environment, particularly from a yield perspective, is going to result in two things. One, obviously, as you noted, there's going to be opportunities. There are alternatives, and there are, probably more alternatives that afford a return that is reasonable with less risk. And I think that that's not a situation that we've been in really for much of the last decade. I mean, we did see a rate hiking cycle prior to the pandemic, but it was very slow and sluggish. And there was really no, I would say, momentum or enthusiasm around it because, there were we were really hamstrung in terms of inflation on the deflationary side. So it was difficult for the Fed to get really aggressive. So I would say this more normalized yield environment produces more opportunities, but I also think it produces, and maybe this is sort of a longer term trend, it'll be interesting to see if this is borne out in the data. I think it probably creates more responsible capital allocation across the board. And so, there's much to be said right now in terms of what sort of excess have we been funding with zero interest rates here in the United States and globally. Frankly, we're not the only people who've engineered some speculation from an asset perspective here in the U.S. But I think it's thinking about, does this create a better crop of management teams? Does this create more realistic expectations for investors in terms of long-term returns? Do we enter an environment where, capital is seen as dear rather than disposable? And does that create, perhaps even, stronger forces for economic growth? That's sort of how I look at this. So the short term is a lot of pain and probably some continued pain and headwinds over the next couple of years as we reset to this environment. But the important thing to remember, too, is that, whether it's 4% or 5% or, I guess even 5.5% or 6%, although that seems rather unlikely if you take our opinion on that, that shouldn't be enough to hinder the economy from growing at some point. And so I think that, you just kind of have to look out the other side and say, okay, are there some positive unintended consequences or intended consequences from this activity? And I think I'm in the boat that there are.
Okay. And you touched on capital allocation and, we might see more responsible capital allocation. And obviously what's come with this rising rate environment has been a reassessment in technology stocks in particular. And, I mean, you could argue that maybe that's evident of that, or you could say, there's been a shift in sentiment. There seems to be a lot more pessimism around the space, and some of the hopes in terms of the expectations for growth and adaptation and network effects and all of these things. There seems to be a reappraisal of that. From somebody in your seat, how do you balance all of that in terms of thinking about, obviously there's going to be ups and downs in the stock market over time, and you want to capture the growth in companies, but you want to be, I guess, cognizant of these potential structural shifts. So how are you thinking about that particular theme?
So in terms of a structural shift, I mean, especially when you think about, you sort of could take it from a number of different directions. If you think about it from the inflation impact, technology is inherently deflationary, and we've heard a lot about that. Now, there's a broad sweeping evaluation of that statement that implies that inflation's not a problem, and I don't interpret that statement to be that way. But if you think about technology as a force for what we've seen even over the last 20 years, I mean, I would say that the lack of wage inflation for the 10 years prior to the pandemic was almost entirely attributable to a combination of globalization and technology, right? So if you have those two sort of forces, I think technology also is we're really entering into an environment where technology as a sector, technology as a segregated investment opportunity, looking at it through that lens is probably limiting in terms of, what you think about technology in a future state. If you think that technology is going to continue to create disruption, innovation, and perhaps most importantly, in a constrained labor environment, more productivity and more efficiency, then you should be looking at the application of technology across all businesses and not necessarily just how, those companies that are producing that technology or creating that technology. And so I think the other thing that's happened is that there was a lot of spending in terms of technology. And so, corporations were spending a significant amount, particularly at the enterprise level, on technology, but even in the consumer, we've increased our technology spend as a percentage of our wallet over the course of the last 10 years. And I think that it created a proliferation of Me Too technologies. And I think that this is probably a right sizing of the repackaging of kind of similar, whether it's software as a service, but just kind of similar go to market, because there was so much capital. So there didn't need to be necessarily as much attention paid to who would win, because everybody was winning. And so I would caution on saying, sort of we're entering this new world. We're back to fixed asset investments. Fixed asset companies are going to continue to thrive and be sort of the leaders. That may be the case from an asset, price perspective, at least in the near term. But that's partially because, technology companies have performed so well. And a lot of that performance has been, loaded into the, prior 5 or 6 years. So I look at it more in terms of, I think that, my belief is that technology continues to fuel the economy across industries and sectors, and that companies that are effectively and dynamically utilizing technology to improve their businesses will end up being better off. And so companies that are producing technology solutions that can help other companies do that, I think will continue to be a driving force for growth in the economy.
Okay, so I mean, taking a step back, and we kind of jumped from kind of the general philosophy straight into markets. But if we were to go back and think about, you talked about the kind of 3 buckets in terms of liquidity, aspirational assets, and growth. How does that then move from there to kind of thinking about asset allocation and constructing portfolios? What's the kind of framework or kind of overall investment philosophy that drives that portfolio construction process?
Sure. So when I made my move from the institutional sort of consulting world into private wealth management, that was right around 2006. And so, we were really caught up in what is the sort of the next phase of investments look like. And if you recall, during that period for U.S. investors, U.S. investments really weren't outperforming. This was the renaissance of international developed and emerging markets equities. Many clients were asking, why do I even own, stocks in the U.S.? This is sort of it was a difficult, it was a challenging time for U.S. companies. It was a challenging time to get excited about growth and momentum here in the United States. And so one of the things that we try to think about is, how has the landscape changed over time? The other thing that was happening then was really this passive versus active debate really started to set up and build its foundation. And so coming out of the financial crisis and really thinking about the reallocation to a lot of passive strategies, I think we just took a big step back over the last probably 7 or 8 years and said, what is that active passive debate mean to us? And what are the implications of that? And our view is that it's important to actively allocate capital at the highest level. However, if you think about that second part of the decision tree, it's like, well, what are you trying to accomplish with that capital allocation? And so are you attempting to capture the beta of a particular market, or do you think that there's enough alpha to uncover? And so the way we think about portfolios is that we're always balancing the opportunity with the costs, and costs are both fees and taxes. So most of our clients are private clients, so we live in a taxable asset world. And so if you think about that, then you say, okay, well, I probably want to be the most active in the places where the alpha should be present at a higher rate, and that's in, less efficient asset classes. And so fully believe in active allocation, and fully believe in the ability for managers to engineer alpha in less efficient asset classes, but certainly believe that for many U.S. investors, a lot of their core exposure is probably going to be in low cost, tax efficient exposure just to capture that beta. And so it's a little bit more of a like second and third derivative type conversation in terms of our portfolio construction, but it just comes back to, where do you spend your money, if you will, from a cost and tax perspective?
So it's kind of like a core satellite with some passive exposures for certain core exposures, and then being willing to pay for certain strategies and markets. Is that it?
Yeah, and I think so. I think a lot of people dilute that down completely to say, okay, all of our marketable exposure will be, passive or factor-based exposure. We're not even going to bother with it. And we take a little bit more of a nuanced view. For instance, we believe that the bond market, for instance, is still very inefficient, and there's still a lot of opportunities if you're buying individual bonds to be able to not only potentially pick up better performance, potentially, but more importantly, if we think about that liquidity bucket that I talked about earlier, the best way to align your clients' assets and liabilities is through a portfolio of consistently maturing vehicles that provide cash without a transaction cost, right? So individual bond portfolios are a great example of, well, that's maybe not the most efficient way to express that exposure, if you will, but it's a way that you can actually add real value from that perspective. So, yeah, I would say, I mean, this has been, at least for me, a change in viewpoint over time. If we had this particular podcast probably with much inferior technology back in 2006, we would have been talking about how very much believed in active management at all levels, at the top level as well as at the implementation level, and that. But the landscape has changed, and the information advantage, particularly for U.S. stock analysts and portfolio managers has really been diminished through regulation. And so if you're all working off the same information and the market moves quickly and reacts, whether or not you believe in the efficient market hypothesis or not, the U.S. large cap equity market reacts pretty darn quickly to new information. So I think that that's where you're maybe there's tougher sledding. Now, with that said, there are some benefits of active management in that space, particularly if you're working around existing positions, if you have a really strong team, if you have a viewpoint that there's a particular factor like dividends, for instance, that are incredibly important for your clients. Active management, even in US large cap, can make sense. But it's just always thinking about, again, going back to the intent of your allocation. Why am I making this allocation? That should be driving what vehicle you're using or what strategy you're using to implement.
Okay, fair enough. It's interesting. I saw an article that it's 50 years since A Random Walk Down Wall Street was written. I think Burt Malkiel was been interviewed in the Wall Street Journal. So the message in that book seems still to be hold true. He was, I think, a fan of passive, and avoid Uncle Sam was one of the other core tenets of that one. So it sounds like you're still very much embracing that. You mentioned it's been a very tough year, which obviously it has, equities and bonds. Both, obviously bonds having a worst year in ever, at least in the last kind of century or so. Is that something that you had, I suppose, transition portfolios for at a time, or in terms of diversification, had thought about that kind of scenario from an asset allocation perspective? And then secondly, now that we've had that big sell-off, does that motivated very different kind of asset allocation looking forward?
So, just to be candid, we certainly were not expecting inflation to be as hot for as long as it has been this year. I think coming into the year, we anticipated inflation to be the biggest challenge for the markets, and particularly as it relates to Fed policy. We were more optimistic, frankly, coming into the year about Europe. We really felt like there were opportunities there we were going to see a sort of broader economic recovery. Yes, we were going to see inflation, but all of the economies are going to be dealing with inflation. And so the war in Ukraine really upset a lot of our thesis kind of coming into this year, just in terms of the undue and frankly compounded pressure on Europe and the UK based on what we're seeing from a energy supply situation. We actually came into the year knowing that bonds were going to be under some pressure, and we had been structurally underweight for most of our portfolios to sort of what we would call our long-term strategic targets. And the reason for that was we didn't feel like we were, from a yield perspective, really being compensated for the duration risk that we were anticipating. And that proved to be true. But what I would say is that we had added some real assets exposure over the last several years. We had added some exposure to our platform, at least. Obviously, for each client, the scenario is different. But we had added some exposure to what I would say are more kind of structured opportunities that had higher correlation, whether it was to inflation or to commodities. And so those proved to be fortuitous during this year. And then in the middle of the year, sort of towards the end of the summer, we just looked at the risk reward opportunity in the fixed income market, for instance, and actually increased back to our neutral weight from a bond perspective, just feeling like a lot of the pain, there could continue to be some residual pain, but a lot of the pain had probably been felt, or at least the bulk of that, in our assessment. And so our view was, with yields where they are, you are getting compensated, if you will, for some of the duration risk, which you certainly weren't getting compensated for in 2020 and 2021. So yeah, that's definitely changed. If you think about Sharpe ratio, for instance, and trying to maximize the amount of return for the risk, a lot of people think about that as just maximizing the return part, but lowering the risk level that can do a lot to improve your Sharpe ratio as well. And so I think that was where we really wanted to try to increase the potential opportunity to at least lower our risk and produce a similar return, if not a better return.
Yeah. And that move back to neutral, I guess, is that reflecting, I mean, is it a belief that that the world hasn't fundamentally changed, and that, maybe some of the themes that might have been in place before this spike might come back, or I guess put another way, the whole, or some of those disinflationary forces, you mentioned globalization, technology earlier. Do you think they're still lurking in the background there once we get over kind of this very strong period of aggregate demand, or how are you thinking about all of that?
I would say that you don't even have to look at it in terms of getting back to deflation. I just think we're going back to a lower growth environment. And so, one of the things that I think gets lost in the shuffle a little bit from 2018 and 2019 in particular was that, we were in a manufacturing recession here in the United States due to the trade war with China. We were experiencing incredibly slow growth from a GDP perspective. There really wasn't a catalyst for any sort of escape velocity for the economy. And if you think about a low growth environment, that implies that you don't have a secular economic tailwind to be able to produce top and bottom line results. And so I just go back to if we're back in a low growth environment, then it comes back to execution, but it does imply that, inflation will ease, and that, the opportunities for more nuanced, potential in, on a company by company basis becomes more important. And so not that I would say, because we haven't obviously seen the rising tide lift all boats in the course of the last couple of years, but you certainly have felt like that, kind of big rush in demand and activity coming out of the summer of 2020 and the return certainly helped a lot of businesses really regain growth on the top and bottom line. And that's why we're seeing expectations for earnings growth come down next year. It's not entirely due to the fact that we're expecting this contraction in economic activity or the depth of, or implying there's a depth of that contraction that's expected. It's really, well, a lot of what you have has probably been pulled forward, and these growth rates are probably not sustainable. So going back to a lower growth environment, it really puts the emphasis on companies to engineer their own growth, whether it's through a number of things: M&A, buybacks, new products, CapEx. I mean, there's a lot of ways you can engineer growth from a revenue perspective, but most companies were not doing a great job of that prior to the pandemic because they were really focused just on financial engineering.
And you mentioned, in terms of having some diversification in the portfolio with real assets, and then certain structured opportunities that were kind of had a beta to commodities. Have you a place in the portfolios, or do you look at more hedge fund or alternative risk premium type strategies in that context for diversification? Or is that a challenge in terms of the kind of costs and taxes and vehicles, or how do you think about accessing those types of strategies, if at all?
So it's a really good question. And I would say that our interest in those areas has been cyclical. And so if we go back to just prior to the pandemic, the couple of years there, our exposure to what I deem, I guess, what you call traditional hedge fund strategies. So equity long, short, relative credit, managed futures. It was pretty low. And it was pretty low because we felt like there really weren't, especially from trend following perspective. I think I did a podcast a couple of weeks ago with one of my colleagues in the bank on FX, for instance, and just looking at, if you think about central bank policy and how consistently similar that was, doesn't create a lot of opportunities there. And I would say that sort of goes for the commodity markets too. We really didn't see a lot of demand. And so, even, interest rates and duration and derivatives on that, very difficult to make money in that environment. What's really changed is sort of what we touched on at the top of the podcast is, there is potentially some bifurcation, differentiation, nuance now in what's happening in the markets. And that really does speak to managers who are making not only a positive call on something, but also a short or negative call. And so I would say the other thing that we anticipate happening, so that sort of speaks to equity long short, right? And whether you do that in sort of a on a limited sort of sector basis, or whether you're in a broad portfolio, is really a question for what your appetite is. But I mean, I think if you look at sector and industry specific long short funds, that's a really interesting space right now. The other thing that I would say that may become more of a opportunity, but I don't know if it's as good an opportunity in the hedge fund structure as it is in more of a traditional drawdown structure is in the credit market. We really haven't, for such a difficult year and so much uncertainty, we really haven't seen a meaningful impact on spreads. And, we haven't hit this wall. I mean, if you go back several years, I mean, how many market notes did I write about this refinancing wall of worry for triple B debt, right? I mean, that was just like everybody was concerned about that coming in, prior to the pandemic. Eventually, the Fed was going to raise rates. All of these companies were going to have to refinance at higher rates. It was, huge wall of worry. It's still there. No one talks about it anymore because we really haven't seen the spread widening that everyone would have expected in this uncertain environment. But I think that there's probably some opportunity in credit.
What do you think that is? I mean, because I was noticing that I was looking at some data earlier on and looking at the different ETFs, and the HYG hadn't seemed to have suffered as badly as emerging market debt or investment grade, and I was a bit perplexed about that. Yeah, given all you said about it was such a theme in kind of end of 2019. Now, obviously, I guess a lot of firms refinanced and the Fed did bail out the credit market in March 2020, but presumably a lot of that debt will have to be refinanced at some point again. And is that not a problem on people's radars? And you're clearly thinking about the opportunity that will eventually follow that.
Well, because I think people are less worried about it because I don't think it will be a wall, right? I think there'll be, fissures in that wall that create opportunity. Because I think companies have come into this. They came into the pandemic, for instance, with, much stronger balance sheets than one would have potentially expected. Where, corporate and consumer balance sheets are much better off, in much better condition than we were in 2006 and 2007, for instance. And so I feel that, with the ample cash, there's also, let's be honest, right? There's still a lot of dry powder out there in the private asset space that, would love to come in and take advantage of any sort of distress or softening, and probably wouldn't wait until it is truly distressed. And so there is a little bit less concern. I think, if you talk to distressed debt managers, for instance, I mean, they've been waiting for 10 years for an opportunity to buy anything that remotely sounds like or seems like distress. But I think it's less about kind of true distress and more about finding, potentially some pockets in the credit markets that are softer and could potentially be benefited by managers in particular who know how to work out credit. I mean, that is quickly becoming something that people don't know how to do. And they don't know how to assess the risk of a company that needs to refinance and can't necessarily refinance. And what is that, if you step into that void for them, what should you charge? And, how do you monetize that? So I just look at that as sort of a longer term opportunity to say, not everything that's been afforded a investment grade credit rating or even higher high yield credit rating maybe deserves that. But it's not going to be a one size fits all opportunity, which is why I think that, operating in the private space for that probably makes better sense than expecting there to just be some sort of huge spread blowout and being able to capture that in the public market.
And you mentioned at the start of those comments, trend following, pessimism around the space, maybe in 2019, the changed environment that we're seeing in FX. And as you say, rates were anchored at zero around the world. Now we're seeing those divergences. I've also seen the argument made that with this kind of new theme of deglobalization, that maybe there's less of a tendency back towards equilibrium in currencies because, if something's cheap in China, Western companies don't want to produce it there anymore because of all of those issues around supply chain. So this enhanced currency volatility may be part of the new era, along with obviously we're seeing, much more volatile commodity markets as well. So with all of that, would you be more open to the kind of manufacturers macro space now, or is that always kind of one that people have a bit of uncertainty about?
So I find it to be one of the most interesting asset classes because if you are a true ambassador or evangelist for diversification, then you should have managed futures in your portfolio because they are, essentially not correlated. The problem is that that lack of correlation in periods where other assets are going up has always been a challenging one for, particularly, I would say, for private clients to really wrap their head around. There's also not, when you're looking at, the underlying holdings of one of those strategies, there's nothing that is going to resonate that, a private client can grab onto and be like, yeah, I get it. I really understand that. With that said, I think that we could be ushering in a new environment where that could be more competitive. I don't know what that implementation or allocation ends up looking like. I do know that it is something that I was attending a conference here in Boston a couple of weeks ago and was talking with one of the managers in that space, and we've known each other for 15 years. And I said, hey, how's it going? And I was like, they're like, hey, do you want to chat? And I'm like, maybe, it seems like we're entering into this environment. And this is a space where one of the things I always tell people is that I think it's important to always acknowledge that as an allocator, it's your job to make the best decisions with the information that you have, but you can always supplement that information, with experts from the space. And so, my podcast the other day with a member of our FX team, that was not only for our clients' benefit, but it was for my benefit too, because I know this is a shifting dynamic. And so I would not be surprised to see more, particularly in the private wealth space, more allocators looking at the managed future space again and really trying to determine what has changed. I mean, the players have changed too, right? How are you? So it's sort of I would say an area where a refocused emphasis, at least from a due diligence perspective, is probably warranted, because we are likely to enter into an environment that is more akin to what we saw prior to the financial crisis. And those strategies were able to deliver performance. And I think that's worth an acknowledgement in this environment. Some
Yeah, no, for sure. I mean, that's certainly what we saw after the 2008 was a lot more interest in the space. And, but, some people might say from a fundamental perspective, there may even be more structural shifts underway at the moment. But that's obviously speaking from the managed futures perspective. But you touched on, due diligence there. So it's a good segue into manager selection. And I know you come from a kind of a manager selection background. So do you find that as a different kind of discipline, manager selection, relative to doing asset allocation?
I do. But I think I really think that the way that I've always looked at it is that you can find an incredibly interesting theme or market opportunity. Or you could find a really focus on an incredibly interesting manager and they have a great process. But, unless there's an intersection of those two, you're not fully capturing the opportunity. And so I always look at it in terms of like, I think that something like trade finance, for instance, is just incredibly interesting. It is a very esoteric niche opportunity set. The problem is that, you then need to find a manager that institutional quality, sustainable process. You can feel comfortable, putting in your portfolios and being partnered with them for a long time. And like, that's the disconnect there. And then there's even more strategies than I can count where you're like, oh, this is a really interesting strategy. It's an interesting team. But I mean, based on our worldview over here in the market, this is going to be a long time. So I would say the way we look at it is from the allocation, sort of longer term allocation, thematic ideas tend to drive idea generation on the manager side. But if there is a manager that we find through our process that we think is really interesting, but we just are waiting for that market opportunity, we've had managers kind of on the watch list for a couple of years until we felt like the environment was supportive for them, because we really do try to create a level of curation in our portfolio that makes sense. It's not too limited, but it's also not, it's not meant to be inclusive of the entire investment universe at any given time. It's really focused on, if we're allocating capital over the next few years, what are the types of strategies we should be utilizing?
And, you say if you come across a great manager or a great team, so what does that look like, or what are the kinds of criteria you have for assessing, obviously there's, I guess, the qualitative, quantitative factors, but, taking a step back and the managers you've really, rated over time, any characteristics that you would think stand out in great managers?
Yeah, so our team has done an incredible job of focusing over the last few years on refining our approach and what makes it different. And I think one of the things that they've very much focused on, which I think lends itself to probably a good positioning, if you will, going into the next few years, is this idea of continuous improvement, and the fact that we believe we are in a very dynamic period for the markets, for the economy globally, for what's happening in terms of expectations for asset classes are changing, expectations for return are changing. And so seeing managers that can be introspective, I hate to use the word humble, but acknowledge where their process may need to change. I think from an institutional lens, the check boxes were always any process, people change, process, people, philosophy changes. And if you said no, that was a positive. And actually for us, saying no over and over again for years and years against the backdrop of a shifting environment doesn't make a lot of sense. And so the other thing is, diversity of thought. And so thinking about the fact that, at some of the best firms, bringing in, perhaps team members who haven't been working, quote unquote, on Wall Street for their entire existence, provides a different lens. I mean, I know when I go out into the field and I meet with actual companies, I get a much better sense of, what I'm reading in the data, in terms of how that is actually being expressed by these companies and the challenges. And it's the same thing, right? Go out there and find experts in the space. So we look at, if it's a given manager, what's worked over time, what parts of their process do they think are critical to being able to continue to produce similar strong returns, but what ways have they changed their process, or are looking to change their process, and is that ongoing introspection actually a part of their firm, a fabric of their firm, or is it something that only occurs when a calamitous mistake has been made. And so I think that allows us to see the manager as kind of something that's evolving. They're evolving their process, and so we can see it as a longer term relationship because we know that they're going to continue to evolve just as we're evolving in our thought processes.
Interesting. It's one of the things you find in the managed feature space as well is that there's kind of constant tension between looking for ongoing improvement and then in style drift or excessive tinkering. But yeah, I think it's a very good point about that kind of introspection, but even without the calamitous error, as you say, that's why if you can have that when it's not just being forced by some kind of big down month or a big down year. And in terms of, that process for selecting managers, obviously, it's easy to have your checklist of people, process, whatever else that everybody does. But then you get to the end of it and then you realize, well, actually, we've been influenced by some kind of behavioral bias here. Do you find that in the manager selection process, and have you developed any kind of skills for kind of keeping those in check?
We have a process by which our manager selection team, sort of lays out their process for selection of a manager to our broader investment policy committee. And I think it's a really good one because it affords us the opportunity to ask questions. And I think that it's improved the process over time in terms of being able to question the team, being able to point out things and seeing those types of questions be further integrated into the process on a go-forward basis has been a pretty clear positive result from that. I think the other thing too is that, like I said, I think it's when you're working with private clients in particular, and I think just across the board, I think that investment people have a tendency sometimes to end up in sort of intellectual silos. So this is a really interesting manager. This is a really interesting theme, and become somewhat dogmatic and then really not hear or respond to feedback from the field that explains why, this isn't, a particularly compelling opportunity, despite the fact that the team is really interested in it. So I would say the bias that I try to make sure is that, we're not attempting to find the next awesome strategy to the expense of something that actually can be utilized as part of client solutions. And so, and that's why I think it's really important to have a good dialogue between, the advisors in our case and the strategy folks on my team, and then the managers folks to make sure that we're all listening to each other and assimilating that feedback into our process. Because if you're not doing that, you end up with a bunch of strategies on your platform that nobody's using. And that's frustrating for the manager search team. It's frustrating for the investment strategy folks who are trying to put together best ideas portfolios. And it's frustrating for the advisors because they don't feel heard in terms of what types of solutions their clients are looking for or needing.
Okay. And in terms of that process for onboarding, it sounds like, is it the case that the manager selection team bring through the managers and then there's a kind of a team overseeing that and questioning that? Is that kind of set? I guess that has been set up as the process to ensure that kind of check and pushback is. Can you talk a little bit more about that process or how you've constructed it to ensure that the rigor around that?
Yeah, it's incredibly important in terms of just, and it's really not the purpose is not to sort of check each field in terms of the due diligence questionnaires. And it's to make sure that we're all working together. We believe that the benefit of working in a firm that is collaborative is to be able to leverage the expertise of different folks. And so while my background is in manager search, there are a lot of other people that are on the senior team for investments that don't have a background in that, but they have a background in fixed income, or they have a background in equities, or they have a background in building out portfolios for clients in terms of, suitability and modeling. And so those folks can bring up questions that if you're, because I was in manager search for a long time, right? So I think I'm more sensitive to the potential for this intellectual isolation than other people are, because I know what it's like to get into a room with a manager and just be blown away and be so excited, and you want to get them on the platform, and then you realize, oh wait, I don't know that I can actually explain that. Because that's another thing that I think people forget. Managers out in the field, right, they don't have time, especially when you start to grow as an advisory force, they don't have time to sell their strategy internally, right? They don't have time to be inside. So we're really the ambassadors and the mouthpieces for these strategies. And if I can't explain it to my advisors, how are they going to explain it to their clients? And how are they going to be able to create that rationale? So as part of this, I think just having this oversight in terms of, yes, for the most part, it's really just to enhance the due diligence or enhance the selection process overall, this oversight mechanism. But it really does allow us, if there's something that is really concerning from the committee's perspective, I, as the CIO, can obviously just not utilize the strategy and say, listen, we're not going to use this. But I would much prefer to have that ongoing dialogue between a broader group, because I do think it results in a stronger process when you have this diversity of thought. And again, you want to make sure that you're not having the subject matter experts be drowned out by people with a bunch of sort of what I would call, what about this questions. But you want to make sure that if there is real pushback, that we address that, and that we make sure that we've documented that as a potential concern, and that we have done some work on it. And so I think as a manager, as a leader, ensuring that everybody who is a subject matter expert is given the proper voice and that their opinion is weighted appropriately, but that also offering up this opportunity for collaboration and thought sharing is a way to improve the process over time.
I just wanted to shift gears a little bit and get your perspective on the industry more generally. Obviously, you've been in an organization that has gone through a couple of acquisitions and mergers, and there's obviously a general trend towards consolidation in the RIA industry in the US. What's your thoughts on that? Is it I guess this race for scale, is it a good thing? Do you think it's going to lead to better offerings for clients? Is there a trend towards delivering more institutional solutions, or is that kind of a simplification? Or, what's your perspective on where all of that is heading?
This is a really interesting question, because it's one that I've been talking about a lot, actually, with a lot of different folks along the frontier in the space. So, when I started back in a registered investment advisor in 2006, product teams, wholesalers didn't even have a dedicated RIA channel. We were either covered by the bank trust team or the broker dealer team, or and I think that what we're seeing today is we're seeing just another pendulum swinging, in terms of, we had all of these brokers who sort of left and went out on their own, and the independent broker dealer, and we had a lot of RIAs that were small and they were growing, but I think the challenge is that once you hit a certain asset size, you do have to make increasing investments, not only in operations and technology and compliance, but you also have to widen your aperture in terms of, well, maybe we do need to work with more than one custodian, and maybe we do need to be able to take in, alternative investments that we haven't vetted, and all of that comes with increasing costs and complexity. And so I think now, for most advisors, what they want to do is advise. They want to be meeting with clients. They want to be sharing their thoughts. They want to be relationship managers. And a lot of those other things that I just talked about sort of dilute the time that they're able to take. And so with most RIAs being led by a few strong advisors, I think that that's led itself to this consolidation effort. However, I do think that there's probably a pendulum shift back at some point where people say, you know what, we probably can do more in terms of fintech. We probably can do more for less in terms of outsourcing a lot of these solutions. And so I think consolidation is important, also because it provides succession. I think one of the best things about what's happened in terms of consolidation is that people are acknowledging that they want to make sure their clients are in good hands when they're no longer managing those assets. And so a lot of the roll-up sort of opportunities have been because those advisors are really looking out for the best interests of their clients and making sure that they are in a structure that they can continue to receive great advice and service, even, as that particular advisor transitions. But I do think what it could create on the investment side is a lot of overlap in offering, because as you get bigger, you need to be able to allocate more assets. And, I think for some of these larger firms, some of them have a very hands-on approach in terms of the investments for the underlying groups, and some don't. But I think that'll be interesting to see. And then the last thing, I know this is a longer answer than you were looking for, but the last thing is really, everybody wants to be in the private client space now. You look at all these institutional firms that are founding their own RIAs that our asset managers are product producers, right? Like, oh, why are we going to these RIAs and then they're putting a fee on top of it? Like, why, we want that, that's a really interesting change, because dealing with people like me and my team versus dealing with the end clients for some of these large asset managers, that's a whole different ballgame. So I'm interested to see how successful those efforts are. But again, I think it just comes down to private clients, RIA clients are, they're in high demand, and there's a lot of competition for them. And so companies are just trying to find different ways to capture that sort of growing universe of very important investment opportunities.
But so from an investment perspective, you think greater similarity maybe between the offerings as everybody gets bigger and has to be able to deploy large amounts of capital? That's kind of your potential takeaway, I guess, is it?
Yeah. And also, it's, I think there's a lot of, it's much easier to apply kind of an institutional framework if you're going across the board. You have a scorecard. You're probably not. Again, I don't work in one of those larger firms, but that have been sort of this kind of aggregator model. But I don't know that you're that incentivized to work with a manager, for instance, that has a really high minimum that only can be appropriate for your ultra high net worth and family office clients, for instance. For us, even if those strategies are not for the broad footprint of our client base, wow, they're really, they're a way to get exposure to a new space. They're a way to get exposure to other investors. They have many advantages that can be afforded to the due diligence process just by partnering with those types of strategies. And I feel like those teams may miss out on some of that if they're really just focused on what can we do for the broad set of clients that we're now working with.
Interesting. Interesting space. It's obviously going to in the state of a lot of flux at the moment, so we'll see how all of that shapes up. Before we wrap up, we normally just like to ask our guests, about, obviously we've talked about your journey towards becoming CIO. If you were to give some advice to people starting off or not quite as far along in their careers as you are, about skills to develop, things to read, things to do if they want to, run multi-asset portfolios, do asset allocation for private clients, and ultimately be a CIO, what would you say to people?
So there's sort of two things that I would say. One is communication, having the ability to communicate across multiple mediums, verbally, in writing, in person, in large groups, making sure that your messaging resonates, remembering that the use of terms and phrasing and narratives that people can really understand and can digest, but also reiterate is really important. I think that that's something that I've learned, that, you don't have to use a lot of jargon to sound really smart. What you have to do is make people understand what you're saying, and that gives you much more credibility. The thing on the path, so I think and this probably is maybe a little bit different from my seat, because I'm a woman who's a little bit on the younger side. When I came into a chief investment officer role, I think that depending on who you work for and who you work around and what you see in your community, there's a tendency to want to be like other people who are in that position. So for instance, if your head of research is a certain way and their skills are XYZ, you believe that you have to have those same skills to be in that position. And someone told me a long time ago, before I became the CIO, they said, I made a comment like, well, I'm not really good at this. And they're like, the role is whatever you make of it. And so just widening your aperture to say, what type of director of research do I want to be? What type of analyst do I want to be? What are my strengths and what can I bring to the table for the company as part of that? And so, not every chief investment officer does their job the way I do my job. And some people do the job wildly differently. But what I've done is I've said, these are the things that I think I bring to the table. This is where I can benefit the company most. And then I filled my team with people that maybe do those things that I don't do as well, in order to create a better group and a better function. And so just don't get caught up in trying to think about what is the ideal XYZ person for a position. Try to think about, I want to get to that position, and how do I make myself the best that I can be to be able to contribute to the company. And it's just much easier than trying to follow directly in someone else's footsteps.
Great. It sounds like very sound advice. Well, thank you very much. I do actually think that makes an awful lot of sense. But we're over an hour, so I'd just like to say thanks very much for coming on. It's been great speaking to you. We've learned a lot. So with that, I'll pass back to Niels.
Thank you so much, Alan and Shannon, for some great insights into the registered investment advisor world, and where you managed to cover quite a lot of ground. I thought it was really interesting to hear Shannon talk about how the younger generation is starting to change their requirements when it comes to the expected returns, but also the risk levels they're willing to take, as this may well drive a change in how asset allocation is done for these generations. Also, I appreciated Shannon's acknowledgement that alternatives such as managed futures and trend following should play a bigger role in portfolios, even if it's still a bit of an uphill battle to explain the lower returns during time of strong equity bull markets. Shannon's insights as to what they look for in their manager selection in terms of identifying the critical parts of a manager's process, but also how the manager is looking to improve upon these, was quite interesting. But of course, there are so many more gems in this conversation. That's it for this episode. Make sure you go and follow Shannon and Alan's work, because as you can tell from today's conversation, it is so important that you understand what is going on from a global macro point of view in order to allocate capital well. And we really look forward to sharing more of these insights as our series continue. From Alan and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.